Hello, everyone. This is Andy Michael with Seven Springs Wealth Group. Well, it's been another wild ride over 3 months in the third quarter, looking at markets and what's going on in the economy. So today, I want to share a few thoughts of what happened in the third quarter, but more importantly, what we're looking at and focusing on, and the investment strategies that we're thinking about as we move into the fourth quarter and beyond into a new year. So with that, let's get started. I want to start today by taking a look at what transpired in the third quarter and zoom out a little bit and see what's happened both this year and over the past 3 years. And if you look across all of these indices, we have the S&P 500 for large cap stocks, Russell 2000 for small cap stocks, international stocks, emerging stocks, even bonds and cash over this year, last quarter, last 3 years. Just being in the game has really been the place to be. So these 3-year returns are just astronomical. What we've seen since that huge inflation spike and interest rate spike 3 years ago was really the bottom of that. And so where we've come since then has truly just been remarkable. And the third quarter was a classic example of what we've seen over the past 3 years. So very, very strong returns through the first 9 months of this year, and in particular, the third quarter saw everything moving up and to the right. Let's take a closer look at yields. We just had the Federal Reserve back in September cut rates for the first time in a year by 0.25%. And so one of the interesting things we like to look at is the yield spread. So the longer end of the yield curve, the 10-year Treasury, compared to the shorter end of the yield curve, the 2-year. And what we've found is quite interesting. We've seen the yield curve go from inverted back in 2023 and even 2024 to now there is a positive yield spread. So you are actually getting more yield for owning a 10-year bond compared to a 2-year bond, which is what we would expect. But what is the implications and what does that mean? That means you are seeing those lower short-term rates come down. So think those business loans that we've talked about over the time, home equity lines of credit, those interest rates, construction loans are coming down, right? So you're able to do and transact and take loans and start businesses at lower rates. But the mortgage market, for example, is attached more to the 10-year yield, which hasn't been moving as significantly down compared to the 2-year yield. So we're still not seeing those long-term rates come down. That the long term is what the Federal Reserve has a little bit less control over. And so we are starting to see that shift in the yield curve and really what that can mean for whether you're trying to start a business or buy a home. It can mean two different answers right now. Let's take a look at what we think the market is truly focused on. And I broke this down into excited and concerned. And I really want to emphasize, I believe this is what the market is focused on. So there's also a lot of political noise going on. There's a lot of economic noise going on certainly with jobs reports, GDP growth, all these things. I think these are the core components of what the market is truly focused on, which is not necessarily what always the headlines or media or news are focused on. But with that, let's go here. So at the end of the day, excited, growth's up, rates are down, right? That's exactly what we want to see. We're actually seeing global GDP being revised higher for 2025, and we're seeing the Federal Reserve cut rates again for the first time this year. So growth up, rates down, that's a very positive and healthy bull market type environment. Same thing for individual companies. We're seeing revenue, profits, margins up. Everything is increasing. So double-digit earnings growth, revenue growth at or above nominal GDP, not only for this year, but expected for next year. So again, very, very positive, healthy line. Just with those first 2 points there, that you have revenue, profits, margins improving, you have growth improving, you have rates declining. All of that is a very healthy underlying environment for stocks. And then finally, we're actually starting to see the rest of the market participate. This is no longer just a Mag 7, big tech, NASDAQ type rally. We're also seeing just underlying small companies hitting a all-time high for the first time in 4 years. So we're truly seeing some of the smaller companies that underpin the broad market starting to participate in this too. So if that's what the market's excited about, let's talk about what the market's concerned about. First off, valuations. We are near 21st century highs right now. So all of those good things we just talked about, they're priced in. We see the S&P forward price to earnings at 22.6 times, which again, that's the forward earnings. That means all those great numbers we just looked at are baked into the price. So again, we could have simply just a multiple correction risk, meaning if the S&P forward price to earnings goes from 22.6 to 20, we could have a 10% correction, and it's just simply some of the air coming out in stock prices without even a full crisis or contagion happening. We're also starting to see unprofitable tech is outperforming profitable tech. So what that tells me is that we're seeing stories and narratives and hopes and promises for the future being valued at higher rates and levels than hard fundamentals, underlying profits, and underlying cash flow right now. Some of those stories will certainly play out. We've absolutely seen that in the past, but certainly not all of them will either. So when I see that, that's just a point of concern that I take note of, that to me, that means stories are starting to win the day right now over underlying fundamentals. And the last thing I want to mention, and this is one that's not as obvious to the broad market, but it really is an AI-driven story right now, not the consumer that's driving the market. Typically, especially in the US, we find the consumer is what drives the market. So the fact here that it's not a consumer-driven market is a very big deal. I won't go through all these names. You can see them on the screen here, but these are some of the biggest, most well-known, largest consumer companies right now, and they are not participating in this rally that we've been talking about this whole time. So where do we go from here? Just a couple of points, especially as we think about year-end and beyond. Risk check. This is something we've been doing with a lot of our clients right now in their portfolios. Is your portfolio risk in the right place? We just looked at what's happened over the last 3 years. So if you haven't really stopped to assess your risk, it's quite possible that your risk has gotten out of tolerance and out of alignment with what your goals are. It's a great time to do it. You want to do it when the markets are at all-time highs, not when we're having these 20 or 30% sell-offs in the market. So great time to check in on your risk, really know what you own and why. Again, we want to focus on those fundamentals. The stories are great until the stories break down. So again, really understand what you own in your portfolio and why it's there in the first place. Go long, consider extending duration. So we just saw that positive yield spread that we're starting to get. We're actually getting paid to own longer maturing bonds. So we're starting to find some value there and taking some action in client portfolios. So be thinking about that. And finally, as we go into year end, tax optimize your portfolio. Is there somewhere where you can do some tax loss harvesting? Are you getting qualified dividends or ordinary dividends? Are there any ways to generate tax-free income in your portfolio? These are things that we're looking at inside of client portfolios right now, looking for any way that we can optimize the tax picture, control the factors that we can control. So that's it for today. Thank you so much again for watching. If you have any questions about the things we talked about, please contact us today, and we'll see you again soon. Take care.